Good morning, everyone. My name is Dan Matuszewicz. I got my start, like many of you, in accounting, where I was an auditor for a few years, and then before joining a local government service, I spent nearly 30 years at the city of Newport Beach, and I have re-entered the private sector. I'll turn it over to my colleague Ira Summer to introduce himself.
Oh, thanks, Dan. For those of you who I haven't had a chance to work with yet, my name's Ira Summer. I'm one of the senior consultants here at GovInvest. In a past life, I was a consulting actuary to agencies across California and across the country. After that, I taught finance and economics to MBAs, and then came back to the private sector to work with GovInvest and with government agencies to advise all of you on pension, healthcare issues, and other financial things. So we're going to be talking today about CalPERS. For those of you who are not familiar with GovInvest, we are a financial software company. We have created a number of products to help government agencies better understand, better analyze your difficult financial issues, whether it is pensions, retiree health plans, going into labor costing, and we can talk about all that later. Today, we're going to be focusing primarily on CalPERS and what's happened last year, what you can expect to happen moving forward, and some of the decisions you should be looking to make moving forward.
And I'll note the software services are augmented by consulting services by actuaries like Ira Summer himself, and finance directors or industry practitioners like yourselves and my background as well. So we'll get started with the presentation. What we hope to go through is kind of a recap of the year-end events, obviously the year-end return, and where things may be going really in light of that high return, the risk mitigation policy, and the ALM study. And then, as Ira mentioned, we're going to talk about some of the risks, threats, and opportunities that these changes might have for your agency and next steps. So everybody by now has heard that the year-end results were 21.3%, and that triggered a risk mitigation policy. And so that establishes a new baseline of 6.8% as the discount rate heading into the ALM deliberation. So it may not stop at the 6.8, but Ira, do you want to comment on the risk mitigation policy?
Yeah, and also a little bit about the return itself. The return this last year did not come from fixed income. Fixed income was relatively flat. About a third of CalPERS portfolio is in fixed income, and I think they actually lost 0.1%, so they were basically flat for the year. But equities took off. On the public equity side, they earned 36% during the fiscal year ending June 30. On the private equity side, they earned 43, almost 44% return. So this phenomenal returns in the stock market, but as we're going to talk about throughout this, do not expect this to be the new normal. We are not going to go back to the roaring 90s, where everybody thought the stock market was going to get double-digit returns every year. This was a great year, phenomenal year, and CalPERS and their investment advisors took advantage of it. But over the long term, CalPERS is trying to prepare themselves for downside risk, to protect agencies against the downside risk and against losses. This is why in 2015, they put in place their risk mitigation policy. In fact, do we have that on the next slide? Are we showing that? Which basically said that if they, in years in which CalPERS investment returns actually beat their assumed rate of return by a big enough amount, which they started as 2%, more with 7, 10, 13, that they would start reducing the discount rate. So, and the reason they want to do that is they want to lower the risk of the portfolio to try and protect against downside risk. In fact, as recently, I think it was in the last day or two, the CEO of CalPERS, Marcy Frost, was on a podcast with, I think, MSNBC, talking about how important it is for them to reduce the downside risk. That that the market has done really well. They don't expect this to be continuing over the long term. We'll talk about some of the reasons why a little bit later. But as they start lowering the discount rate, as they start lowering the risk in the portfolio, then if we get years where the market drops down, CalPERS won't, the portfolio hopefully won't drop quite as much.
And just to add on to that, a minor correction is it was on CNBC, and we did provide that link to you at the end of, in the reference material of this presentation that will be mailed out. There's a link to that video as well.
Yeah, there are too many NBC stations, and yeah, I can't be expected to, yeah. So,
everybody's heard about the Alm study, and this is where they studied capital market assumptions once every 4 years, as well as a number of other demographic and economic changes. And we're in this July time period, or past that. We're starting to, in the September board meeting, they will. They've spent the early months educating the board, and now in September, they will introduce some candidate portfolios for review. And this is an excellent time to engage with PERS and let them know how you feel where that discount rate should be, because it is a trade-off. You can lower the portfolio risk, but if you're not changing the benefits by lowering the investment returns, then by default, that's an increased cost to the employer, which will not only increase costs, but add amplify the costs for employers down the road.
And for those of you who think you have not heard about this going on, all of you should have by now received a link to your June 30, 2020 actual evaluation reports. And in the cover letter at the beginning of those reports, on the first page, it talks about the fact that CalPERS will be completing their experience analysis and their study and making decisions this November. So one of the few things that's in the 2020 reports that were not in the 2019 report is basically a notice that this is part of the regular 4-year process that they're going through and they're looking at. Again, the draft experience study will be coming out in September. For most of you, if you're having trouble sleeping, there'll be an opportunity to read those reports, and that should help. They are as a former actuary, I find them fascinating with a lot of useful information, but for most people, they're going to be very difficult to get through. The important thing to focus on, and we'll be talking about it here, are the implication of the changes, the reasons for them. And as we talk about some of the impact of these changes, while CalPERS is going to be making the decisions primarily based on I don't know if the science, the economics of where they expect things to be, They do try to listen to the public to try and figure out ways to in terms of timing. So that may be some of the most important things to think about.
And just so you know, they're not pulling these numbers out of the ether. It is a long process, and they study, obviously review past returns. But there's more to it than just what they earned in the past as an indicator. They're also surveying, the top investment advisors to pension plans in the country to see where they think their asset classes can produce returns. And we'll talk about those survey results on the next slide. But they also review kind of macroeconomic conditions, what changes in demographics in the population, slowing population, aging population, what's technology doing, et cetera. So when the survey results came out, and these are surveys from Goldman Sachs, Makita, Wilshire, and several others, their long-term rate of return based on their current portfolio mix is about 6.2%, and that is the indicator of what their long-term expected return theoretically should be. But we know that there will be, this is a board decision, and certainly there will be, folks that may want to oppose this. Maybe it's labor groups, maybe it's agencies to advocate for maybe a middle ground between 7 and 6.2%.
Okay, we've got a question that came in related to asking whether we believe that the COVID death rate and future pandemic unknowns will have any impact on the upcoming actuarial assumptions. And that's a difficult one because CalPERS takes a look at all the information that is out there. But they are not forced to, just like they are with the economic side of this, past performance, no guarantee of future success. They're not forced to say that the past will repeat itself exactly the way it did. I don't believe there is any expectation right now that we are going to be having a global pandemic every 4-year period. I really hope we are not planning on having a pandemic every 4-year period. So I believe that what CalPERS will be doing is giving different levels of credibility to different parts of their data. That the pre-COVID data will probably be given slightly higher credibility than what's happening in COVID. That in the short term, personally, I'm not expecting to see a lot of changes on the demographic side because everything was skewed so much by COVID results, partly by COVID, the disease, which pushed death rates up higher than it will be over the long term, but also COVID, the recession that caused a lot of layoffs and early retirements, more than I think we can expect to see moving forward. So over the long term, this will be built in. Over the short term, whether they end out having a lot of it show up in the 2020 demographic changes, I'm not expecting much, but this is a difficult thing for actuaries to deal with. And so far, I have not heard, I think the CalPERS actuarial staff and their senior team has been very quiet about exactly how they're planning on dealing with this because it's so complicated and they're going through trying to figure out the right balance to have moving forward.
So on this slide, we were just trying to illustrate the dilemma that CalPERS is in, trying to keep costs low while trying to maintain the health of the plan. And so we modeled for one particular city, what their amortization or their total cost would be. That's represented by the blue line. And then we showed, what that might look like if we, actually dropped the discount rate to 6% and they earned 6%, steeper costs on the front end, but then over the long run, after that those costs would abate, and they would be lower in the future. Conversely, with the 7% discount rate and just absorbing the lower than expected returns, that will have a muted impact in the short run, but long term produce higher costs.
Right. This gets back to the general principle of funding for pension funds or retiree health plans, OPEB, that the sooner you put the money in, the less expensive it's going to be. You're going to be getting the power of the investment return. And the better you are, the better the actuary is at projecting results, the more stable the costs will be. So the green line, if they actually change the discount rate to 6 and stay at 6, relatively steady costs. Yes, there's a higher cost up front, but it's relatively steady, more predictable. If they get 6% return, but try and pretend it's not going to be there by staying at 7, the red line is just moving in a slightly upward trend and continues to go upward. The long-term costs go up and you never end up paying for the whole thing. So to actually get it paid for, you need to have reasonable expectations and put the money in, ideally up front. And that's why CalPERS is looking to make these changes, and ultimately is going to try and get to a place which is their best guess as to where they think the investment returns will be. This graph shows why the risk mitigation policy was put in place partly, and also why now is a good time for them to think about lowering the discount rate without causing too much harm to many of your local budgets. The blue line where we start is where things would have been if they had just earned 7% this year, which in previous years we would have been happy with. That's where costs would have been if they had hit their target. On the other hand, by earning more and having the risk mitigation policy kick in, we get to the green line, which is lower costs coming in over the next 20 years as the gain from investments gets amortized with the 5-year ramp up and then level dollar. But as they look at the potential additional changes to the discount rate, notice that over the long term, they can shift it up to, or move the discount rate down to 6.5 or even 6.25. And over most of the time period, be about the same that they would have been with your expectations of costs before. But very important, and I'm sure you're all noticing this, the costs in the first few years under the lower discount rates are higher than they would have been otherwise. The reason for that is because under the amortization policy that kicked in with the 2019 valuation, which starts for payments that you're making the current fiscal year, the 21-22 fiscal year, that those amortizations are, we're phasing in investment gains and losses, but everything else, assumption changes, experience, are all level dollar that start right away. So the assumption change ends out adding to the cost right away, raising the cost. The investment gain gets phased in over a number of years. Now, CalPERS recognizes this, and this is part of their discussions, and this is part of the feedback that I think they would appreciate to get from local agencies as to how you might like, if they're going to drop their rate to 6.5, to 6.25. Would you prefer that they do it right away and you have an immediate impact on your budget, or that they phase it in like they did with the assumption change discount rate assumption changes in 2016, 17, 18, where they went from 7.5 to 7.375 to 7.25 to 7% over a 3-year period, phasing in the impact of this over time. Ultimately, they're going to get to the same place, but how fast they do that is the question. And here is a graph showing the impact just on the normal cost. And one of the things to remember is that employee contribution rates for PEPRA members are linked to the normal cost calculation. So with a big enough decrease in the discount rate, employee contribution rates for PEPRA members will also increase. And again, keeping in mind, and this all goes to the concept, if you're wondering why, the lower the discount rate, the less money they assume comes from investment return in the future, the more will need to come from contributions. So if less is coming from investment return, more needs to come from contributions, both from the employees and from the agencies. And that's going to add to the normal cost and add to the unfunded liability.
So as far as timing, when is this all going to happen? Just for your reference, the impacts to the rates would be for public agencies in the 23-24 fiscal year. But that's all subject to CalPERS decisions if they choose to phase it in, as Ira mentioned, over time, or perhaps they net the investment return and the discount rate, and where it impacts the discount rate immediately, but there isn't that 5-year ramp. Maybe perhaps they decide to bypass the ramp and give immediate credit, or net the two different, one the gain, but net the unfunded liability that's created by the lower discount rate if they net that against the returns, and amortize that in separately is a distinct possibility. We just, I don't think either the actuarial office or the CalPERS staff know what the board is going to decide either, or have contemplated, what that might look like under those scenarios. So we'll all be waiting to see what that plan looks like moving forward. So I mentioned a hidden cost, and it's nothing nefarious, but I wanted to point out that, in the early, late 90s, early 2000s, when they had a couple of years, very good years of investment returns, that it sort of masked the cost of the benefit enhancement formulas that were introduced, because the plan was well funded. And so that's, I just want folks to keep in mind, when we looked at the costs back then, it appeared that making such a change wasn't too apparent, because there was this assumption that those high returns would continue on forever. But as we know, the good times didn't last forever. And so, part of our caution is, just be careful about not assuming that the assumption where we are today will continue. So usually the good times are followed by a series of either low or negative returns. And, hopefully we have a couple more years of good returns, but there's no doubt that there is some downside risk that where markets are hitting all these highs, you can't stay at those highs forever. At some point, there'll be a kind of a reversion to normalcy, or a reversion to mean averages, or reversion to the mean. And so I'm bringing this slide back. We showed this earlier today, but just in terms of the sensitivity analysis, because of this large investment return, even if they go to 6.5%, the return doesn't look like it would be that costly. In fact, it's cheaper than the default assumption. But this picture can radically change as investment returns do, down the road. So what we, also showed is what happens to that same, just isolated. We didn't adjust all these other scenarios, but just the 6.5%. If they had a .com event, what would that, what previously looked like, hey, that's pretty affordable. But if we have another event, then it would increase the cost substantially from where things are today. And it may not be a .com event, could be something more muted, which we'll show on the next slide. But Ira, sounded like you wanted to make an additional comment.
Yeah, it's just keeping in mind with a lot of things related to pension funding that volatility is not always your friend. This year, volatility went to the good side. On the other hand, a drop in the market can hurt a lot more than an increase in the market. So because as the market drops, the asset values drop, the payments are still going out the door at the same level, so that the total value of the trust ends up going down both by the market drop and the payments. Then when the market corrects, there's not nearly as much money left in there to go back to the same place, so that the market needs to move up a lot more to fix it than it does to go down. And with whether it's the .com bubble bursting or the Great Recession or whatever we're going to call the next one, because there's always going to be a next one, that's going to end out hurting. So preparing for it, being aware and being ready to give yourself some cushion. And we're going to talk about that in this very soon in this presentation, about the things that you can do to put your fund and your agency in a better place to be able to handle the next market drop, the next recession.
So this is more of an extreme event, but we also know that things could perhaps, I think everybody's in agreement, 21% isn't realistic to assume going forward. And I've heard CalPERS staff and consultants refer to it in two different ways. One consultant referred to this 21% run up. Think about that as borrowing from future years' returns. We had a great run up, but it's more likely where the market value of assets are today, or the stock market values will tend to moderate over the coming years. I heard another example where one of the staff members compared it to finding a $20 bill on the sidewalk and put it in your pocket, thank your lucky stars, but when you come back next week, don't expect to find that same another $20 bill there.
Well, not on the same block. Yeah.
Yeah. So we looked at another scenario. Is okay. Well, what if things aren't? It's not a big shock, but if they, I think there's consensus in the near term. There's reasons for optimism, but there's also reasons that things will moderate. And so if we had low returns, and one of the reasons for you would expect, if the stock market doesn't continue at that with those 40 and 30% returns that Ira mentioned earlier in the private and public equity sectors, we know fixed income yields still remain very low, and they're expected to stay low. So when they are that low, it's difficult to imagine how they would get back up to 7%. But even at 6.5%, if they had returns, in the 5% range or 4% range in the future, that could have also an equally changes the picture, and it may change your opinion whether you think 6.5% is an appropriate rate. given that there could be a substantial cost increase in the future if returns again are return to lower than what we've experienced in this last year.
Right. And again, a reminder for those of you who don't remember the numbers from earlier in the presentation, that the expectation for the next decade is closer to 5%. So that even if in the long term, CalPERS is expecting to hit 6.25%, 6.5%, the expectation for the next decade is it's going to be a tough one. We may be able to squeeze another year of good returns out of the market. But after that, a lot of the signs are going to be pushing towards lower returns moving forward. Combination of, as we talked before, demographics, population, and all the bad things. Basically, my previous training as an actuary, Dan's in finance, are to look for the cloud in every silver lining, that something's going to be going wrong. And if you think you've gotten through one, there's going to be more. And this graph, this is what I go to sleep thinking about every night, this picture. We're about to get hit with everything. So there are a lot of reasons why when you have an opportunity to set money aside to prepare you for the downside, that look at how well you weathered the 2020 recession. Think about whether you need bigger reserves moving forward and in different places, because there are a lot of things that can potentially be coming.
So, this is, I had the opportunity to do several presentations with Shane Kavanaugh with GFOA. And one of the things that they really stressed when we were looking at kind of a risk-based analysis of reserves is that uncertainty is usually underestimated. There are certain things that we know, volatility in revenue streams, certain costs, but there are things that we can't predict. The impact. Whether it's another wave of COVID, whether it's climate change, or maybe it's just really changes as a result of the pandemic in how people, either choose to re-enter the workforce or not, or run to the suburbs. But uncertainty is usually underestimated, and so we're also reinforcing the need to, while times are semi-good, we had a good return, and the pandemic, I think for most cities, the impact on revenues was far less than they thought it was going to be. And the message is, don't spend those reserves, but consider filling up any contingency reserves that any reserve buckets that you may have had had to either tap into, or you just simply need to replenish them to better prepare for the future.
I think because of everything that's happened in this past year, your boards may be more receptive to preparing for downside risk because they've just had to deal with it. They still remember the pain of making the decisions in this last year, whether or not you had furloughs and had to lay people off, whether you had to cut salaries, whether you had to stop projects that they really wanted to have happen because of not having sufficient reserves, because of all of the uncertainty. And when the uncertainty was right in front of them, they had to deal with it. They couldn't push it off as much. So this may be one of the opportunities that you have to be able to deal with this. Because there are so many things, and this is just a partial list of the kind of things that could completely derail the economic recovery that we're going through right now. Whether, again, we don't expect to have another pandemic, but the political uncertainty, even here in California, the potential recall can sort of put things, throw things off the rails. Congress very easily, we've seen it before, not pass bills that seem almost all the way through. So not going through the list, not trying to add other strange things to it like earthquakes, fires, alien invasion. So this is, again, an opportunity to prepare.
So, again, I mean, I think as a group, we're all pretty conservative, trying to maintain that budget flexibility. Some of my former bosses said, a good finance director never runs out of money. And part of that is, budget conservatively on the revenues, budget high on expenses. So these are a number of things that you already likely are already doing. Want to emphasize the need for long-range planning, whether it's pensions, capital infrastructure, or revenue volatility. But again, to reference some of Shane Cavanaugh's work, cash is king. That is the cornerstone to financial flexibility. So make sure your reserves are replenished during these times. And I showed this slide before at least another CSMFO chapter meeting, which is an article from the Harvard Business Review. It is old, but it also identifies that, hey, when the future is clear enough, a point forecast is fine, but given the amount of uncertainty, that approach may be dangerous. So kind of prepare for some of those alternate futures or outcomes, either through augmenting your reserves, or at least when you produce a forecast, I'll show give your baseline plus a, show your boards a, potential, what could be the downside and what's the upside. And I think if you think about it, that the downside risk is likely greater than that upside potential, given where we are today.
And when looking at those different potential ways of seeing uncertainty, as you bring this to your city council, to your board, where you as financial professionals may be able to understand and deal with some of the more complicated approaches, some of the true ambiguity or the range of futures. When you're trying to get to decision making, the concept of alternate futures tends to be a lot easier for the boards and the city councils to deal with, not showing them all 10,000 possibilities of what might happen in the future, but be able to take a few very representative alternatives, show them what could happen under each, and have them prepare a response to each of these, so that there are just a few limited in scope where they can get their head around it, get their hands around it, and make decisions and be prepared for the future. One decision at a time.
So, moving on to strategies, which folks I think are most interested. I've been trying to hammer the point home that reserves are that cornerstone of flexibility. 115 trusts still represent another opportunity for finance directors to prepare for the future, or internally. And this is, sort of an ongoing kind of debate on depending on how you use this. If it's truly a long-term reserve, and that's something that you would need in a very short term, a 115 provides you a lot more opportunities and allows you to customize your investment strategies. If you invest with PERS, you're agreeing to essentially a 60-40 portfolio, 60% private and public equities, 40% being fixed income and real estate. So it does give you the opportunity to say, well, I don't have those negative cash flow concerns that PERS might have, And if I can tolerate more risk, because we have a very long-term focus on when we might use these monies, some of the, many of the I think all the providers provide some strategies that are more conservative than CalPERS, and they have strategies that are more aggressive than CalPERS. So definitely something to consider. And again, another shout out to GFOA and that reminder of cash is king, and ultimately reserves are that cornerstone to financial flexibility. Ira, did you have any further comments?
Yeah, although on the investing front, part of this is the trade-off between when you think you're going to use the money, the flexibility you want to keep, and that's what it's taught. One of the things it's mentioning here. Having the most flexibility is always keeping it in your internal reserves, because you can then take it and move it all at once to some other purpose. The 115 trust is a little bit less flexibility. There's still some flexibility because you can use the money in the 115 trust to make that year's payments, your required payments to CalPERS, or just move it over as an additional contribution. So the money usually is invested for a longer than a few months period. It's usually a few years. And that's why most of the investments tend to be conservative, not as conservative as the internal reserves, but to be able to get you 2-3% more a year on that money for a 3-year, 7-year period can turn into some significant amount. If you're really thinking you're not going to use it until you're going to take the money at the end and move it all to CalPERS, then you've got the situation where Dan's talking about, where you can really roll the dice. And although not all providers, the CalPERS 115 pension vehicle tends to have their two options are conservative and more conservative. But if you go with some of the private providers of 115 trusts, they give you more flexibility. And if you want to roll the dice, put it all in Powerball tickets, Bitcoin, and GameStop, and see if you can solve all the world's problems. That's because you don't need the money for 20 years. That's a decision you can make.
And I've seen, in this opportunity, in this capacity, working with and for GovInvest, that I've seen a number of clients use some pretty creative strategies to, find money for their 115 trust, or rationales of how to get counsel to invest in it. Some have set up have resident to send them some money to CalPERS, but I've got a goal to fund my plan to 100% by 2032, and they have set funds aside in order to make those payments. Some have essentially voluntarily said, I'm gonna fund at, assuming the discount rate is 6%, and the component that's due to PERS goes to PERS, and the component, if they will reduce the discount rate to 6%, goes into a trust. I've also seen folks starting to set up saying, hey, all these windfall gains, revenues weren't as bad as we thought. Start to use that, or even look to the future, saying, hey, as these credits start impacting my budget, I'm still going to continue to budget the way it was before, as if the 21% return didn't occur, and I will bank those savings in a 115 trust. So if the market does turn, they can use it for those purposes as well.
Right, and especially if CalPERS decides to phase in the discount rate reduction, so that it's going down to, let's call it 6.25 over the next 5 years, that to start funding as if they've already done it, putting the excess into a 115 trust will allow your total pension budget to stay relatively level, to start earning some extra return, while still just giving CalPERS the amount that they're requiring at any point in time. It's an option. So a lot of the things to think about, the options to go through will depend on your expectations of where CalPERS is going and what they announce coming up this fall.
But it is another tool that fits in with the, replenish reserves and, preparing for your own financial flexibility. So definitely something to consider. There are more other, if you're, just playing the long game, you can chip away at it by making just additional discretionary payments. You notice that, payment on the front end doesn't provide a lot of relief. But if you're, if those additional discretionary payments are paying those longer bases first, you're saving the most amount of interest over the long term. But it's not going to be as impactful on lowering your rate. If you need budget relief, you can direct those ADPs to those shorter bases, and they'll produce less interest savings, but provide you more budget relief on the front end.
So if your agency didn't have a lot of revenue volatility in 2020 with the COVID recession, and you think things are going to be relatively steady, and that's true for certain types of districts, then going for the long-term savings may be the best financial decision for your agency to save the most money over the long term. If you were hit very hard with the recession, have a lot of revenue uncertainty moving forward because you're not sure where the economy is going to be going, you may want to focus on creating more budget relief, paying off shorter bases, getting rid of that peak that is out there of the contribution rates increasing for the rest of the decade. Create some budget relief for the next few years during the tough times, and have it that way. But that's not the only way to do it. And Dan's got an approach on the next page for those of you who don't have extra money.
Yeah, for those of you that know me, this is, one of my favorite tools is either doing a full fresh start or a partial fresh start. Does give you the opportunity to lop off that peak or crown if your agency has one today, or maybe it reemerges in the future when, either bad returns occur or a lowering of the discount rate. It's subject to a savings test, so you can't just extend out the term, re-extend back out to 20 years if you're already, you've got some bases that are really short. So the two ways there are more than one way to accomplish that. In order to, the savings test basically says that the sum of the payments under the original amortization policy, whatever you propose in a fresh start, has to be less than your original payment. And there's two ways to approach that. You can either shorten the term, and that might, some folks say, well, that's like a 15-year mortgage, it's going to make, I can't commit to that payment. But if you notice in this case, it really lops off the peak, and your rates were going to go there anyways. So leveling it out is a good defensive option. You can also use, if you have some windfall savings, a little bit on the front end magnifies because PERS, just like a gain or loss, if you make a payment up front, they're going to take that payment and assume it accrues interest at the assumed discount rate. So over a period of time, a contribution on the front end also achieves enough savings, and it may be enough to pass that requisite savings test. But yeah, you can either make a payment up front or shorten the term, which also might be attractive to your counsel as well. Just being careful that you're not pushing up a fixed payment above where you are comfortable with. And that's, I think a lot of people are afraid of it for that reason, but it really isn't a scary thing if if you are lopping off that peak, and you can fresh start every year if you want. Ira, do you have anything to add on that?
No, this is, again, good advice, good things to look at the different options that are there. If you have again, budget surplus this year, to figure out the right combination of money to CalPERS, and again, combining the fresh start with additional money to CalPERS at the same time can allow you to make a move like this, rather than, so thinking about it together as a holistic approach rather than as separate decisions gives you the opportunity to combine these things, potentially fresh start and lop off the top while you're giving them extra money.
And finally, if you have still have an appetite for POBs, you do need to model some of those potential risk rewards given where markets are today. This is illustrating how we can help you show what your, the lavender color represents your current debt service or your payment on your amortization of your unfunded liability, whereas the darker purple and the bond payment would represent, if you were able to borrow at 2.5% and achieve some savings, it's going to, once you take those proceeds, give it to PERS, it's going to reduce your required UAL payment. But obviously you have to look at what your bond payment is going to be, look at that together and see, is there savings, number one, and then stress test it to say, how does this change if it's followed by a downturn in the market or lackluster returns in the future? Ira?
Yeah, I mean, first of all, for those of you who are worried that you may have missed the chance to do pension obligation bonds, rates are still low. We're still hearing about bonds being issued that rates less than 3%. So the opportunity is still out there, but so are the risks. And the big risks are that you borrow money at a rate that is more than CalPERS earns over a time period. So the lower the rate you get, the better off you are. But the other risk, as Dan just mentioned, is volatility. That if you hand CalPERS 50 million, 100 million in pension obligation bond money, and the next day is when the market tanks and drops 10%, 20%, they will have lost not just 20% on your regular assets, but 20% on that additional money you just gave them. And that may wipe away any potential gains that you can expect to see from this. So mapping out the risks, running through them, understanding them, and thinking about how you're going to deal with it, just with any other long-term decision, very important, so that you and your board understand the risks and can potentially address them before they occur.
As we're quickly running out of time, we have some kind of concluding thoughts. Again, stressing that use of exercising professional skepticism to say things may not continue on this path. While things look rosy today, things might change in a heartbeat. So, how are you going to prepare your agency? We know the good times won't last forever. They just don't. So given where we are today, how will you prepare your agency for what may be lurking around the next bend? And
you want to, as you hear often, hope for the best, prepare for the worst. As my grandmother used to say, anything good happening is a lie. So the world is something bad is right around the corner, and be ready for it.
I wanted to give a shout out to really the stakeholder communications and stakeholder relations unit at CalPERS. I think they've been incredibly transparent about what they're studying, what they're looking at. So they are tipping their hand. They tipped their hand early on that they're looking at the risk to the portfolio given potential downside risks and volatility. And if you query ALM or the asset liability management on the CalPERS website, they have a whole landing page dedicated to what that process, where they are but after seeing what some of those costs might do to your plan, maybe that's giving you some pause for thought. Maybe I'm not comfortable with a 6.25% return or even a 6.5% discount rate. So you can provide, you don't have to, there's still virtual meetings, but you can provide written comments by emailing the board at calpersca.gov, and that will get to the entire board in advance of the meeting. Or you can make oral comments at their September board meeting, and I've referenced the phone number on this page, as well as the link to the asset liability management. So I don't think they could have been more transparent about what's been going on, what they're thinking about. It's been very helpful for all of us to see where they're heading. Hats off to CalPERS for being as transparent as reasonably possible about what they're looking at. And then in terms of next steps, I mean, we'd always, encourage you to kind of quantify the range of outcomes. You may not, have to get into that in-depth discussion with counsel, but at least coming up with, hey, here's my base case, but look at some alternate scenarios of, where, what might hurt you in budget. Keeping the board informed, even if you don't know, what exactly is going on. Give them the heads up that their decisions are coming down the road. Advocate on base, so few folks do. Anybody that does advocate on their agency is likely going to be heard. So it's not a wasted effort to send an email to the board stating, your position on what you think the discount rate should be or the impact it will be. Evaluate those strategies, and don't be afraid to seek help. This is a dense topic. And Ira and I have been working on this stuff for years, so we live and breathe this. You're spread thin, so lean on. There's a lot of resources. Call your CalPERS actuary, call us, call your financial advisor. There are plenty of folks ready to step in and help if you've got questions. But if we can help, or if you've got questions about our products, please feel free to reach out or email success@govinvest.com, and they can get you additional information on either this presentation or or other products that you may be interested in as well.
Yeah, I mean, our customer success team as always, we'll be checking in with all of you who are GovInvest clients every quarter on a regular basis. But if this is becoming urgent, contact us. Send us an email, give us a call. We'll get you in the queue. We will help you to the extent that we can. So don't be shy. If this is something that you consider important right now, start taking action. Make the call, send the email.
So with that, we're at the top of the hour. If there are any questions in the queue, Kristen, that are relevant that we can address now, happy to field any.
I don't think that we have any additional questions. Thank you so much, Dan and Ira, for all of the insights and helpful information today. I can't just say enough how much we appreciate all of our clients who joined us today. Again, go ahead and get in touch with us as a follow-up to this and help plan out your next steps. We will be distributing the recording and the slides later on today, and have a great rest of your afternoon.
Thank you, everyone.